Hello, everyone. It's my pleasure to be speaking with you today at the Connecticut Insurance Department's NextGen Career Academy Conference. Today, I look forward to engaging with you to talk a bit about trends in the insurance industry and some best practices for success. I should qualify this by saying that when I talk about insurtech and fintech, I do use the terms interchangeably. In a moment, I will introduce myself officially, but we've launched a new program in fintech, a new master's program. And within that program, we use sort of a McKinsey definition of fintech that also includes insurtech, regtech, and medtech. All of which have tentacles in the insurance industry. So when I do speak about those, I'm going to speak about those in somewhat of a global fashion. So let me introduce myself. My name is John Wilson, and I teach in our Operations and Information Management Department in the School of Business at the University of Connecticut. I am also recently the architect and academic director of our new MS FinTech program, as well as our FinTech certification program that we just recently launched. I have over 10 years of experience in course development and delivery. I was instrumental in the design and launch of our Center for the Advancement of Business Analytics, and I was also fairly instrumental in the ongoing design and evolution of our master's program in business analytics and project management. When I'm not in my academic domain, I am a consulting data scientist with LIMRA. LIMRA is a 104-year-old trade organization focused on research and thought leadership within the financial services industry, specifically in the life insurance industry, as well as the annuity industry. So between my academic credentials and my corporate credentials, I have quite a bit of reach into what's going on in the insurance sector and the financial services sector, both from an academic perspective as well as from a corporate perspective. So as I mentioned, we recently launched a fintech program. That's what has brought me here today to speak to trends in the fintech and insurtech ecosystem. Our program, just to give you an idea, is a 36-credit master's program, as well as a 12-credit certificate offering that consists of a mix of analytics, technology, and business courses. And it's really intended to prepare the student for entry into the world of financial services technology, or as we call it, fintech. Now, when I think about trends, many of those trends revolve around the nascent technologies or the applications of technologies, be they new ones or ongoing technologies. And it's really these different types of connections that make fintech, insurtech. Now, UConn, as one of the economic engines of the state, one of the reasons we launched this program is because we have a strong understanding of the need for talent and workforce development. It is my assumption that many of you are attending today, either because you are considering a career in insurance or financial services, or you are considering a change within the career of financial services. And understanding the trends and where jobs are going to be and what technologies are going to be involved would be part of your due diligence in understanding what your potential is out there in the business world. So again, I mentioned that we have an ecosystem that really revolves around this notion of fintech. As you can see, insurtech is listed. It utilizes technology such as artificial intelligence, drone technology, satellite technology, blockchain, cryptocurrency. It really is a robust landscape where you think about insurance and you think about actuarial underwriting and things of that nature, but there are so many applications of technology and blockchain that are being implemented that you really need to have sort of a different perspective on what it means to be in the insurtech or fintech industry. So today I'm going to talk about some of the trends that we are starting to see out there. And to do that, what I've done is I've reached out to some of our advisory board members in our fintech program. I certainly see trends. I attend many of the major conferences in insurtech, in regtech, and in fintech, and I'm able to see a lot of the trends that are going on there just by participating in the sessions and talking to companies, et cetera. But I also wanted to reach out to some other industry experts, and so I've selected some from our advisory board to get a sense of what they're seeing out in the industry as well, and I'll share some of those with you. So our first advisor is Scott Roberts. Scott Roberts is Senior Vice President for a firm. And one of the trends, and it's not really a trend as he discussed it, but it's an observation, is the impact of rate increases on fintech. While the rate increases are really designed to tamp inflation, there is going to be some repercussions on companies. Many of you may have heard of these companies becoming what they call unicorns. These are fairly new companies that quickly established business valuations in excess of $1 billion. And much of that was driven by what we would call easy money. Many of these fintechs over the last 8 years, according to Scott, have had the benefit of building their products and really just focusing on the customer experience and their technology while interest rates were effectively zero. And so as a result, they had very little interest in really understanding their capitalization because money was so easy and so cheap to get, easy to get and so cheap. Today's inflation data, however, has locked the Fed's interest rates increases in for a few years. And eventually these increases are going to force these fintechs to pass the higher rates on to their customers. So higher rates on loans, but they might not be able to pass along the rate for savings products since most of them were absorbing some of these costs internally. And what that means is that some of the advantages of these fintechs, some of the efficiencies that allowed them to have perhaps lower rates on loans and offer higher rates on savings, that compression is going to go away. So according to Scott, he believes that many of the fintechs have underdeveloped their treasury and capital markets. Funding is going to become a challenge, and commitments that they've made about being low rate alternatives will become harder to promote. So what is likely to happen is you're going to see a bit of a shakeout, very similar to what we saw in the dot-com era. And for some of these companies, they may cease to exist. Other companies may merge with similar companies, or they may become subsumed into larger financial institutions. And we are starting to see some of these trends occurring as we speak. Another one of our advisors, Sangha Penisetti, founder and CEO of GoalZeal, has noted a couple of things that she feels are happening in the insurtech space in particular. The first is around cloud and edge computing. For those of you who don't know, cloud computing, I think most people are familiar with Amazon Web Services and the like. Edge computing is really focused on devices out on the edge of this cloud, as it were, things like sensors and telematics. Adoption rates are fairly high across different industries, particularly in the industrial sector. But the insurance sector will see a tremendous amount of growth in this space over the course of the next 3 to 5 years. Many companies are looking to improve their data sovereignty, their autonomy, their resource productivity, latency, and security. And to do that, edge computing will become an operational necessity for many of these organizations. We are already seeing this, particularly in the reinsurance sector, the property and casualty sector, and group sectors. When you think about your Fitbits and telematics in cars and some of the things you're seeing on some of your smart devices, the Internet of Things, those are all helping insurance companies better understand risk and better be able to price their products. The other thing that has Sangha really excited is the notion of open insurance, similar to the idea of open banking. Open insurance is somewhat analogous to open source software, but in this case, instead of actual software, it's grounded in what we call application programming interfaces, or APIs. It's going to be intriguing to see how insurance-related personnel and non-personnel data is accessed and shared via APIs. By 2032, according to Sangha, there are estimated to be more than 800 million open insurance users worldwide. So there are some executives that I have spoken to when I think about their technology needs and I ask them questions about how they're looking to staff. The common thing used to be, well, we need people who are really good with data, and then it became we need people who are really good with analytics and the ability to deploy those technologies. And increasingly, what we're hearing is we need people who understand how to configure APIs. APIs act as sort of the middleware, if you will, between multiple systems. And what they do is they allow solutions to become scaled up in a fairly technology agnostic manner. Our third contributor, I guess we'll call them, is Margo Giles. Margo Giles is CEO of Go Giles Incorporated. And what Margo is excited about is the user interface, user experience. This is particularly true with the prevalence of mobile technology. Margo believes that there's going to be a massive shift away from the traditional user experience, particularly insurance. And design thinking will be driving the acquisition and servicing for insurance, and it will emulate more of an Amazon experience. Having said that, though, it's probably not likely that there will ever be a true ease of purchase experience similar to Amazon, due primarily to the complexity and regulatory considerations of insurance. Unlike Amazon, where you can simply go in and click on a product and read reviews and things of that nature, insurance is a somewhat complicated product to understand. And of course, that's dependent on what kind of insurance you're talking about. Certainly automobile insurance is fairly easy to understand. Homeowners, maybe a little less so. As at the time of this recording, we just came out of Hurricane Ian, and many people are starting to discover that coverages they thought they had, they really don't have, and they're starting to understand how complex their homeowners agreements are as it relates to covered risks and perils. So whether or not that experience can truly become an Amazon-like experience is really going to depend on how we can streamline and better simplify some of these products for people to better be informed and better be able to really engage in an Amazon-like manner. So what about me? What trends am I seeing? Well, there's three big trends that I've really taken notice of this particular year. To give you some perspective, I've gone to about 15, 16 industry conferences, anywhere from 500, 600 attendees to one that I just recently attended had 9,000 attendees. And three things are clearly emerging when you think about the sessions and what has everyone excited. And those are blockchain, ESG, and embedded insurance. So blockchain, everybody thinks about blockchain. They think about cryptocurrencies. Obviously, Bitcoin and Ethereum and all those are gathering the headlines. However, it's other applications of blockchains that are going to emerge, particularly in the reinsurance space, in the establishment of NFTs or non-fungible tokens for real estate, and the potential for blockchain to create a single record of truth in the medtech industry. There's a multitude of other applications that are being considered or in development with blockchain, and where those go and how they are implemented is still to be written. But I will say that I'm very confident in suggesting that blockchain as a technology is definitely here to stay, regardless of what happens in the crypto markets. ESG, or environmental and social and governance considerations, have really seen tremendous pickup in the amount of resource allocation and focus of organizations. Obviously, people are more prone to do companies that have a social conscience. We see that time and time again when companies either have a data breach or they've been accused of having practices that don't particularly lend themselves well to either diversity and inclusion or fair trade or fair labor. And so increasingly companies are looking to technology to help them solve this ESG. It's not really a conundrum. It's this focus that is necessary to do business in today's climate, particularly with social media. These social media platforms really are accelerating the ESG pickup. It's not uncommon for a company to have a stumble and it quickly take over Twitter or TikTok or whatever. And some of these social initiatives are also emerging that are focused on financial literacy, banking the unbanked, global sustainability, and things of that nature. In fact, ESG is really becoming a valuation metric for investing. How invested are companies in their ESG initiatives, and that becomes a determinant on social and practical investing, or at least on setting up portfolios of companies that are very ESG minded. Finally, one of the biggest things that we're hearing in the insurance space is this buzzword of embedded insurance. You probably have encountered embedded insurance, particularly coming out of COVID. When you book travel, for example, at the very end of your booking, you get a little thing saying, would you like to protect your trip for $10 or whatever it is? And if anything happens, you'll be covered. That's an example of embedded insurance. However, it's going to go beyond those more traditional use cases, and I'll give you a couple examples. Tesla has been able to embed vehicle insurance right with their purchase transaction. It used to be that you go and buy a car at a dealership, and then you would go to your local insurance agent or whatever and secure your vehicle insurance for that car, but now they can be part of the same transaction. General Motors has also launched an extensive insurance practice that can embed the insurance experience right into the vehicle experience. The concept isn't new, but some of the technology, or more specifically, the terminology is fairly new, and definition applications are definitely expanding. There's some companies in the space like Cover Genius that have really established a strong foothold, and Cover Genius has embedded insurance relationships with some of the most prominent companies that you will see out there. I don't want to name any of them specifically, but if you just Google Cover Genius, you can see who they do business with, and the names will be familiar to all of you. So as you can see, there's a lot of different trends, and it really can be difficult to keep pace, not only for someone who's considering a career in insurance, but certainly for companies to understand emerging trends, as well as regulators, academics. When we think about curriculum, we really have to understand how dynamic this ecosystem is and try and keep pace with it. So I have a recommendation. There is an organization called CB Insights. They're a really terrific resource to keep up to date with what's going on in the fintech space, whether it's banking technology or payments technology, insurance technology, et cetera. And you can sign up to receive regular emails that also talks about funding rounds, capital markets, the availability of funding out there, new companies, new technologies, and the latest in consolidation amongst all these companies. So a great resource to keep up with what the trends are, and to get a sense of what has staying power and what doesn't. So with that, I'd like to thank NextGen for inviting me to speak, and I'm wishing you well on your career aspirations in insurance or insurtech. And for any of you that would like to connect, have any additional questions of me, or would like to simply speak with me, my email is on the screen, john.wilson@uconn.edu, and I'd be happy to entertain a conversation. So with that, I will say thank you and wish you well for the rest of your day.